Good evening to all the people who've logged into this broadcast this Friday evening. My guest this week is Mr. Prasun Gajri. He's the Chief Investment Officer of HDFC Life Insurance. He's been with the firm for almost 11 years, has had a stint with Tata AIG Life Insurance prior to that, and even with Citibank. He is a BTech from the Punjab Engineering University in electricals, and after that, he moved on to the IIM Ahmedabad, which is a dream for most people in this country even today. And after that, he holds the CFA degree as well. So a very distinguished past and a very varied past with that. And we'll try and understand a little bit about all of that from him as we go along. Prasun, good evening. Thank you so much for taking time out. It's good to see you. And I hope you and your colleagues and family are safe.
Good evening, Rahul, and thanks for having me here. Yeah, absolutely fine. Hope the same for you.
Absolutely. So, I think you are probably the third or fourth guest I've had running over the last 3 or 4 weeks that has had a very similar educational background. BTech, IIM, and for some, the added CFA. I've always wondered, and I always start my interview asking people as to how they went about such a cross-functional role from engineering to the IIM, Ahmedabad, and now into managing assets and the CIO of a life insurance company. Talk to us a little bit about the early days and how these moves happened. How did engineering happen per se, and then sort of from there the IIMs and CFA and to do getting down to doing what you are today?
See, I mean, we are old now, right? So good old days.
Are we?
Maybe not you. So good old days, say late 80s, early 90s. Living in a small town India, so I belong to Ludhiana in Punjab, and staying there. If you were decently good at studies, the only career options you had was either to become a doctor or an engineer, because everything else was looked down upon, and very few people ended up picking commerce or arts. So I was reasonably good at maths and science and stuff like that, and as a natural consequence, you decided to choose between one of the two. I just couldn't draw diagrams for anything, so decided that biology doesn't work because they can't even manage a simple diagram. And therefore, maths, physics, etc. was much easier. So moved on there, and as a consequence, moved on to engineering. Once in engineering, you realized, wasn't too bad a career, but at that point of time, you suddenly realized that, okay, if you don't want to be hardcore engineer, you don't want to be in pure technical side, you won't want to be more on the sales side and stuff like that, then it's much better to kind of move on and do your business degree rather than sticking on to a pure engineering background. Because unless you really, and I really decided that I don't want to be a hardcore technical person as in R&D or stuff like that. So as a consequence, you decided that, let's try and do an MBA, because that is what it was. And to take the exam, somehow you managed to get in. To my surprise, I did manage to get into Ahmedabad. Yes, it's a bit of a luck there because they take a less number of students. But if you're lucky on that particular day, you kind of get one extra question right, and there you are, a part of the institute, and had great 2 years there. And while I was studying there, it was very clear to me that I wanted to be more on the financial industry side. More in the area of finance than anything else. So that was a very conscious choice. So when obviously you get onto the placement side and decide, okay, fine, who are the day one kind of guys? At that point of time, there were very few investment banks who used to come in. So it was either the larger foreign banks who were there, or domestic investment banks like ISEC and SBI Caps, etc. So Citi used to be a pretty preferred job at that point of time, and I guess still it is, along with ICICI Bank and all. So yeah, Citi was day one, managed to get in, and spent around 7 years with Citi, doing everything apart from investments actually. So my first job was in the area of custody services. which is basically supporting the backend for investments. So, and those were the times, this is 1995. And that was the time when markets used to be physical. So we had a huge vault in our office with all the physical shares stored for various investors who were our clients. And it was always a challenge, and you always had to reconcile what was there on your system and what was there in the vault as physical shares. When someone traded and bought something, you'd have to send it out for registration. So I remember a lot of time we used to actually spend on all the juniors who really joined. We actually used to spend a lot of time even signing transfer deeds. So virtually half an hour, 40 minutes every day, just signing transfer deeds for getting the shares transferred. So yeah, that kind of pickled my interest in the investment side, to be honest, because and I was part of the team then which led the transition from an operations perspective to the demat mode. So that happened when I was pretty much as a part of that department. So that kind of got me interested much more into this area than I was prior to it. Yes, I used to invest a little bit here and there on my own account, but it wasn't as involved as that made me, because it really helped me understand the markets a little bit better, because I used to work in customer service there, as used to have a few mutual funds and FIs as my clients, talking to them what they're and figuring out what they were selling, buying, what was going on, etc. Kind of gets you going. So from there, I moved on to and Citi allowed you to kind of move roles. So after a while, I moved on to the corporate banking side. So I did actually corporate banking sales, having a set of clients across Mumbai and Gujarat, selling corporate banking products, including cash management, trade finance, treasury, and stuff like that. And at the same time, being responsible for the credit. So I was also, and Citi used to have the dual role at that time, which allowed you to be a credit analyst as well as. So credit analyst was actually another area I enjoyed, whereby you really got down into understanding the numbers of a company in fairly great detail, and then kind of setting up credit limits for that company. So it was nothing to do with equities, but that is what it was. And that is in fact what landed me my next break. I never joined, I eventually joined Tata AIG, but I was part of AIG Global Investment Group, now the infamous AIG Global Investment Group, which eventually did not survive the crisis. But I was part of that team from a global perspective, and was also responsible for some investments they were making in India on the credit side. So I was taken as a part of the Tata AIG team because it was assumed that, like a lot of other countries, it will be a credit-heavy portfolio, and they required someone who really would handle the credit side. And since the investment part was a very small part to start with, and someone who would learn the investment part along with it. So I thought that was a good opportunity to get into a new sunrise sector and also look at investments apart from what I anyway knew on credit side. So I had never done any equity investments till that point of time. So I'm probably one of the few guys who has never worked on the sell side, never been an analyst per se on the buy side as well to start with. But yeah, the first time I did equities, I was technically the chief investment officer, though it was a two-man team in Tata AIG. At that time, Tata AIG. So, so investments came along, started doing fixed income, credit, supporting the AIG Global Investment Group, and the ULIP boom came. And that forced us to learn equities. So I learned equities on the go. We had an advisor appointed, learned from him, took a lot of help from people like you on the sell side, understood, got into depth. And at that time, portfolios were very small, had the luxury to really spend time, go through it. So by the time portfolios became of any size, I managed to kind of learn the ropes on the equity side. So therefore, having worked both on the fixed income and the equity side within the insurance space. So around 11 years back, as you said, I changed my job, moved from Tata AIG to HDFC Life, and there I am. So I joined as the CIO, which at that point of time, obviously was a small portfolio compared to where we are today. It was a smallish team. So yeah, it has been a great journey since then. By and large, most of the team which is there was hired after I joined, maybe apart from one or two people. So, and we have grown as a company, grown as a part of the AUM, grown in complexity of the portfolio. Yeah, we have seen ups and downs, but it has been a great journey at HDFC Life since then. So that is it. So that is what I have done on the investment side, and that is the kind of career I've had. So a bit of an accidental investor in that sense. Started off more as a banking guy, and then moved on to investments. Yeah, that's the
Sometimes
long
those
answer
are
to.
fascinating stories, Prasun, when you just start off accidentally and land up somewhere totally
Yeah, I
different.
guess
But
just meant to be.
yeah, I guess. I mean, City is not a bad place to start. In fact, I started my career with City after my undergrad in Chicago. My brother actually continues to work for City in New York. So it's it's not just when you did your placements. It still happens to be a preferred choice for a
It
lot of
is,
people.
and I still have a lot of friends who are doing very well there. So yeah, it's a great place.
Absolutely. And I can tell you, I myself gave the CAT exam, I think in 2002, and I had got a 94 percentile, and I was sitting back and expecting calls, and I didn't get it. And I think that's probably the first time I realized India has a population problem. There was 94 percentile if I didn't get a call. But
Hmm.
that being said, you said you come from Punjab.
Right.
It's the auto hub of the country, at least at one end. Of course, the South has its role to play, and then of course you were an engineer. So your parents never pushed you into perhaps doing something in the engineering side, despite having done your undergrad in that. It was pretty much
Not
left to
really.
you.
So my parents never really pushed me into kind of forced me into anything. I think the only time I was told was to look at engineering as a career choice, and frankly, I had no real problems with doing that.
Mhm.
After I moved out of my house in Plels, because I stayed in a hostel in my college, it was clearly my choice which way to go and what really to do. My father was a scientist, so he was not really concerned in terms of as long as I did well at studies and was happy doing what I was doing, he was perfectly fine with what it was. So yeah, I never got that pressure of working on the engineering side.
Interesting. You are, of course, the CIO of probably the most expensively valued insurance company in India, and perhaps some would argue even in the region. And you could probably benchmark
Hmm.
with a lot of global insurance companies to HDFC Life Insurance. Uh, your processes, how have you gone about conducting business? As you said, when you joined, the team was small, the AUM was small. Today, you're running a very large 5-digit crore business on the equities side. How is your pretty much every metric of yours, if you were to be measured by you're in the top decile or the top quartile, if not the market leader. So how has this journey been? What were the systems and processes and the thought process when you started this journey? When you look back, what are the things that went right? What are the things that went wrong, and what did you learn from them?
Oh, that's an interesting question, to be honest. I think in our area of investments, especially from a fund manager's perspective, processes is something which most fund managers, frankly, don't like too much, right? In a sense that everyone wants to be left alone because everyone believes they know what they're doing and they know best, and these are the companies to be invested in. And yes, to an extent, that is right. Fund management is a personality-driven thing, and every fund manager has a stamp of authority in terms of what he's doing, and his personality is reflected in his fund stock choices, the way he manages his funds, etc. But my learnings over the last whatever time I've spent in the investment arena and in the financial services arena, I think processes are extremely important. And what we try and consciously do at HDFC Life is to ensure that none of our funds is overtly dependent on the fund manager per se. Yes, fund manager is extremely important. But at the same time, we have to have certain processes which we follow across all fund managers in the team. Certain discipline we follow before we take any steps. Certain powers which we give to the fund managers, but at the same time, some checks and balances are put against those powers. Certain powers are given to the analysts, whereby in certain cases, even the fund managers may not be able to overrule some of those cases. So, and all these processes were frankly not known to me when we started out. So as you go along, you get through the phases, and all your learnings come through when your funds are not doing well. You frankly are on a euphoric high when the funds are doing very well. So when I started off, frankly, it was just before the 2009 election results when I joined HDFC Life.
Mm-hmm.
And luckily for us, not my doing, but luckily for us, we were virtually fully invested at the time the results came out. And the stock selection also kind of worked in our favor, but more so there was very limited cash in the portfolios. And when the markets really ran up in 2009, we did pretty well. And the portfolios in the past were not doing that great. In 2007-8, in the downturn, the HDFC Life portfolios hadn't done that well. So we did very well in the 2009 about turn when the markets really moved up. And the portfolios turned around. So I got a bit of credit for that lucky move in a way. And most fund managers, they should thank their stars, because sometimes you're lucky without really realizing it. And that is another learning which has come through, that you can be lucky without really being smart, and you can be smart without being lucky. And therefore, you have to always balance the two out. But there it was. So post that, the funds continued to do well. And then 2012-13, our funds actually did not do very well again. We actually underperformed the peer group, we underperformed the benchmarks, and that was probably the last time we were underperforming the peer group. Since then, we haven't done that, and also the benchmarks over a period of time. And that is the time when got a lot of pushback from, and that was the peak of ULIP boom. So distributors used to really push you back in terms of the performance if it was not going as per what their desires were or as thought they should go. So a lot of pushback came through. So that is the time when we really analyzed the portfolios in detail. And 2-3 things came out, at least in my view, and that is what I then instituted within the company. And at that time, I tried to talk to people in the market, because the senior people in the market, some of them figuring out what processes. Frankly, I did talk to a lot of Standard Life people in Edinburgh at that point of time in terms of what processes they follow, because they also had a fairly process-driven investment system. Adopted some of those for our own doing. And few lessons which really stood out for us, I think, was one is risk management. How you really, so you can choose a stock and you can be very good at choosing a stock, but constructing a portfolio is very different from just choosing a stock. So how much of that stock needs to be in your portfolio? How do you express your bullishness in a way, whether it is being 1% overweight or 5% overweight? Where do you draw the line? Similarly, if you're bearish, how much underweight do you want to be? Where do you really draw the line? Should I be zero in a stock which is 8% of the benchmark or 6% of the benchmark? Or do I kind of say, okay, fine, I don't like it, but still I'll be 3% in my portfolio? How do you really decide your sectoral limits? Where do you want to cap them? How do you really ensure that you have a uniform strategy across, or at least some semblance of uniform strategy across different fund managers? What is the house view? How do you reflect the house view across different portfolios? Are your different portfolios behaving differently? Then is there a house view in the first place? Or is every fund manager on his own? So a lot of these things, frankly, we learn on the way. So today when we operate, to cut the long story short, we have 2, 3, 4 very important points. One, we always have a house view. We don't have funds by different fund managers which perform diametrically opposite. Yes, there will be some variance in performance of the fund managers because it's not all uniform. They will have different stocks in their portfolios. But by and large, we will have directionally the portfolio is moving the same direction. Because we do believe that as a fund house and a large money manager, we do need to have some view. And it cannot be that I express that view one way in one fund and completely diametrically opposite in another fund. So that is one. So we have a particular process whereby certain names where we believe as a house we need to be overweight, everyone is overweight in those stocks. So, and that is a process we drive through part consensus, part discussion, whichever way, but end of the day, we remain overweight on some of those names uniformly across most of our funds. Second is in terms of how much risk you take and how important it is to be in quartile 1 every year. So our view is, and frankly, I have a very contra view. Instead of trying to drive a quartile 1 performance every year, if I can even drive a quartile 2 performance, but as long as I'm consistent in quartile 2 every year, frankly, I've seen over a 5-year, 7-year period, you end up being in quartile 1. So you really need to decide over what period you want to be quartile 1. It's impossible for everyone to kind of be better than the peers over every time period. If you try and focus too much on the short run, say I want to be quartile 1 over next 6 months, 12 months, sometimes you end up being quartile 3, quartile 4 over 4, 5 years. It's a a very different ballgame. But if you really try to be quartile one over a longer period of time and try and drive a consistent performance, that to my mind has worked for us very clearly. Third is the risk you take in the portfolio. And while there is no right answer to this, I do believe from an insurance investor's perspective, it could be very different for mutual funds or any other investors. For an insurance investor's perspective, any person who puts his money through insurance as an investment tool, the expectation is the insurance guys will be a little bit more conservative, is the feedback you normally get. The risk they will take will be lower. So what we believe is that we are very calibrated in terms of taking what risks to take. Fourth is, instead of trying to find winners all the time, and it's a very difficult thing to keep finding winners, it's far better to kind of figure out, make less mistakes and avoid the losers. And that actually helps you do a better job in getting the final results. It's a less glamorous way of getting the results, but it tends to work fairly effectively. And fifth is, I guess, you follow a particular process to do what you know, and not try and kind of go overboard and say, ye bhi karunga, wo bhi karunga, doesn't work. You have a particular process, you follow it. If you believe the process is getting stale, ossified, not working, review the process, but don't throw it out and say, I'm not going to follow anything. So when we analyze a stock, we follow a particular process. If something has to be added to the universe of stocks, a particular process and rigor has to be followed. And frankly, we were not doing it maybe in 2009, 10, 11, when we were very small as a team. So you have to have the right kind of resources for that. And once you start following it, you realize if you get your inputs right in terms of the processes and the way you think about it, the results eventually come. They may not come for 3 months, 6 months, but they eventually come. So yeah, these are some of the lessons you have learned over a period of time. And hopefully these are working for us, and hopefully they will continue to keep working as far as we are concerned.
This answer that you just gave, Prasun, is very similar to the one that Mr. Prashant Jain had given me from your sister firm when I had spoken to him a couple of weeks back. And he spoke at length about systems and processes. And interestingly, you used the words luck and hard work. And he spoke about the importance of working for the HDFC brand and how lucky he was that that had happened to him. So I just want to understand from your perspective, obviously returns is something that investors are always looking for, and you probably feel the pressure, but at times do you feel you get away with the fact that you work for an HDFC brand and that has helped you immensely in this journey as well?
Oh, absolutely. I mean, there's no denying the fact that HDFC Life brand helps you, or HDFC brand in that sense helps you immensely. There's an implicit trust in the brand. So, but it at the same time puts a lot of onus on you, right? So if the brand is what it is, you have to kind of, your actions have to reflect the ethos of the brand. And somewhere your processes, the way you really work on a day-to-day basis has to reflect that. So therefore, we are very cautious in terms of where we invest, what kind of exposures we take, what kind of concerns can arise from that. And that is a part of our day-to-day diligence. So yes, it's extremely lucky to be a part of the brand. No doubt about that. Helps immensely because you start with the fact that people trust you. So now your job is to kind of make sure that you uphold that trust. So you already have the trust to start with.
In fact, just this morning I was having a chat with the fund manager and we were discussing HDFC Bank, and he used a beautiful phrase to describe it, and he said, with great power comes great responsibility, the famous line from the movie Spider-Man. So it sort of beautifully summed up not just the bank, but I think the entire franchise that goes along with those 4 alphabets cutting across, maybe even into general insurance and other aspects as well. You spoke a little bit about how investors approach investing via a mutual fund vis-a-vis an insurance company. Where are we in that process of investor maturity today in terms of them not panicking when it comes to market volatility? Do you find that the investors that come through you are a little more long-term oriented than mutual funds, or is that not a fair comment to make? Is there a certain coming of age of the investors who are investing through insurance companies in India vis-a-vis mutual funds?
It does look like, I mean, the data over the last 2.5 years does point out that people have been fairly sticky with the investments. And even the data we saw last month, the SIPs are still reasonably, you're still getting, say, $1 billion in SIPs. So on top of that, you may see the money flow coming in, going out. So that has become a fairly stable source of fund flow for the mutual fund industry. As far as insurance is concerned, yes, I completely agree that the insurance investor is relatively more stable than the mutual fund investor, because I think somewhere the investor mentally compartmentalizes the two investments in a way that this is meant probably for maybe 1 or 2 years, 3 years, maybe insurance is meant for 5, 7 years. So on a relative level, yes, but at the same time, the pressure and the way the investor would react to poor performance is not very different. So there is no getting away. So people may be willing to give you 3 months, 6 months leeway, but beyond that, yes, the performance has to come through. Maybe a year, but performance has to come through. But the last 2 years, yes, I also have been pleasantly surprised by the way things have gone about. So I think great job done by the mutual fund industry there in being able to get this going, get the SIPs going, helps the entire system and helps long-term savings, which is eventually what the aim of the entire industry is.
You guys had a very good product launch last year, Prasun, and that product did really well for you guys. And like I was saying, you guys are pretty much setting the benchmark in most aspects in the insurance industry. Sometimes do you get worried when you talk to people and they talk about the valuation of your stock? I'm not specifically asking you to comment on it, but sometimes you just look at, say, my goodness, when I'm benchmarking myself to global insurance companies, this is how valuable my franchise has become, and I'm just so privileged to be a part of it. And how do you view that? I mean, it just becomes a very difficult sell for us to be selling your stock, I can tell you, compared to some of your peers. But when you look at it from the outside, how do you view this? And it's not just for you. I think HDFC Mutual Fund is the most expensive listed mutual fund. HDFC Bank is probably the most expensive listed bank. I mean, how much of this is the reputation of HDFC? I mean, that's does it worry you that the margin for error is very, very little now when you're sitting at the top of the mountain across the board pretty much?
So look, as I said, extremely privileged to be part of the group. So no doubt about that. Very difficult for me to comment on the valuation. That I leave to what the investors say. But I think internally, as in one of our discussions, my CEO basically said that all we need to do is put our head down and keep working. Rest everything will take care of itself. So as long as we do our jobs, frankly, valuation is something which the market will give. So as long as I do my job, my colleagues do our job, and the results keep coming out, things should be fine. What valuation gives is a function of what the market really perceives and what multiples are there from time to time. So there's no control on that. But yeah, for us, it is, for me personally, it is basically doing the right things over a period of time and doing them consistently. And we try to do our best on that count.
Do you think that this pandemic that we're going through, Prasun, is going to make insurance an integral part of the spending of families going forward? Say perhaps maybe even more than mutual fund investments. Say maybe let's look at a consumer staples versus consumer discretionary. So mutual fund insurance companies probably more a consumer staple, mutual funds more maybe a consumer discretionary. Do you think that this pandemic will probably change the way people look at insurance companies and the product itself?
I sincerely hope so. And I do believe so at the margin. See, very clearly, early signs on health insurance are fairly good because health insurance has actually done very well over the last few months. Yeah, I think it's a good analogy you draw in terms of staples or discretionary. I don't know if mutual funds, but also in my view, should be a part of the staples, but insurance definitely. Because this is something where you realize that risks come from every side and any side. And before you really do anything, and when I'm managing the fund as well, you always have to take care of the risks. Returns never come without taking risks, but risks still need to be managed. And so similarly in life, I do believe insurance plays that vital part of really protecting the downside for you. And yeah, this period has given, I think, a lot of coverage to insurance and a lot of realization across the board. So we hope that this actually leads to some sort of a behavioral change on an ongoing basis, where people start looking at life insurance particularly, and as well as health insurance in a more holistic manner, and something which should be part of it. See, when you're 24, 25, starting working, life insurance is the last thing in your mind, I guess. But hopefully, with this phase, people will start looking at it in a manner which should have been looked at all points of time. And also, I do believe somewhere in India, while we all save, and India is a savers market, very few people invest. There is nearly no planning behind the investment thing, right? So when you talk about any kind of investment, whether it's for a particular purpose, a goal-based, or retirement, or whichever way, you're just leaving some money on the side and then not really figuring out whether that money is really working for you or not. So I think this period should be a good wake-up call for everyone that saving is fine, but somewhere that saving needs to be done with a particular plan, with a particular objective, and go about it in a little bit more scientific manner, and make it a core part of your the way you really handle everything else in your life. And insurance will be a very, very vital part of that planning process, in my view.
You spoke about having a top-down approach. You spoke about processes, risk management. How do you approach the process of picking up a stock? There are subjective elements to it, and there are objective elements to it. Objective you can get through facts and figures, annual reports. The subjective part, of course, is corporate governance and how a particular company can be perceived completely differently by two different set of investors. So internally, when you guys are brainstorming across a table, what are the thoughts that go through your mind when you are picking up a company? What drives an investment decision?
Fair. So we follow a combination of top-down and bottom-up approach, and our sectoral calls are more top-down, but stock picking is clearly bottoms-up. So when we look at our stocks, see two, three things. One, we have probably one of the lower turnovers in the market. Not exactly a broker's delight, but that is what it is. So when we look at stocks, clearly the intention is not to sell it in 3 months, 6 months. Intention is to hold it over a longer period of time. And when you want to hold something over a longer period of time, clearly the things which you look at are not short-term triggers. You look at the growth trajectory, can it sustain? Is the balance sheet good enough to kind of sustain that growth over a period of time? Is the market size enough for this company to grow? What the competitive positioning is? The usual stuff. I mean, nothing very different from what everyone else will look at. It's just that our focus on those longer term factors is probably slightly higher than. So I will not necessarily buy a stock where there is a trigger of something happening over the next 1 month and the stock can give me 30%. Doesn't really work for us. Maybe the stock is a great idea for someone else and maybe it gives those returns as well. It is something we may do at the margin a little bit here and there, but that is never going to be a part of the core construct of the portfolio. So if you look at my core portfolio, it doesn't change much over a period of time. So we are happier buying companies which do well over a longer period of time, where governance is not much of an issue by and large. So obviously there are gray areas here and there, and you can never be fully sure. But the idea is to clearly look at companies where you do not have those headaches emerging from time to time. Yes, you still get accidents once in a while, but by and large you try and avoid that. Focus a lot more on the balance sheet. A lot of times on the equity investing, I've seen that the focus is too much on the P&L. Focus a little bit more on the balance sheet, the credit side, the ability to generate cash. How long can they sustain the growth without raising further capital? How the capital allocation has happened in the past. Yes, corporate governance forms a very, very important part of where we are, and we have rejected a number of companies in the past where, frankly, stock returns have been fairly decent, but it just doesn't pass muster. And that's another lesson actually we have learned. And there is nothing called if you miss out on a particular stock that you're missing out on anything. Never make the mistake of saying, well, this stock, unless I buy, my portfolio is not going to perform. There are enough and more choices available in the market. And if you don't believe you like something for various reasons, it's better to avoid it and stick to what you believe works for you. And yeah, so effectively, frankly, we're not doing anything. I mean, stock picking is not something which is a rocket science. Everyone looks at the same factors. It is a question of what weight you want to put onto certain factors vis-a-vis the other factors. And our focus is clearly on the longer term. Trading is not something we are very good at. We hardly do that. So even when I look at my analysts giving me top ideas, which we are overweight across the board, the viewpoint is at least a 12-month viewpoint. So that stock has to do better than the market, say, over a 12-month period. I don't care how it does. Yes, we'll track the 3-month, 6-month and ask the right questions if it is not. But as long as our assumptions are being met and it's just the market not responding to it, we are fine with it. So that is the intent, and that is something which we do. So lower turnover, sticking to it, managing the risk. And finally, very clearly, let's all remember that in these kind of portfolios, we are managing against a benchmark. We are not trying to give any absolute return. And when you're managing against a benchmark, there are certain constraints you live with. And be aware of those constraints when you're investing. So you always have your limits in terms of how much off benchmark bets will you take, where will those bets be, which sectors, the liquidity of the stock. So some of those factors really come into play. But idea is clearly to look at something. If I can buy something and hold for next 3 to 5 years, I'm very happy. Let me put it simply that way. That is something which works for us.
If I'm not mistaken, in school you were also into dramatics.
Oh yeah, those are good old days, yeah.
So the last 4 months have been nothing short of drama in the stock markets. You've had a 40-50% fall in the Nifty and an equally sharp rally again. How do you resist the temptation when a stock you hold is constantly rising? And how do you reconcile your thought process when you've done on your channel checks, you've made an investment in a company and it doesn't work out as per what you had thought? So when you're looking at both spectrums, and you spoke briefly about benchmarking a little earlier in this conversation as well, it's probably a very tough job for a fund manager. I've come to know a lot of you over the last 10 years, and I know it's a very tough job. How do you reconcile both ends of the spectrum when things are going really right?
Look, it's tough. It's tough. End of the day, you may have the best ideas. If the market is not supporting you and the stock is not rising, it doesn't really work out. So it's, I guess, a judgmental call as to where you draw the line. And when you say, okay, fine, enough is enough, maybe I'm wrong, and not kind of make it an ego issue that, boss, I'm right and this has to perform. There's a finite time limit. What that time limit is a more of a judgmental call. But for us, very clearly, we do not take short-term calls. For us, that time limit could be maybe year and a half, 2 years, possibly. Similarly, if the stock is falling and assumption not coming out true, so two things we do. I think one habit which we have as a team incorporated, not just me, I think the team as well. We try not to react to any news, whether it's extremely positive or extremely negative. And sometimes that works, sometimes it may not, because so let's assume a bad news comes, and in some cases, selling immediately is probably a good idea. In some cases, good news, buying immediately may be a good idea. But given our processes, the given way we work, and given our time horizon within which we operate, we typically don't tend to react to news. We kind of try and absorb that news, wait it out, try and see what the implications can be, talk to people around, talk to the sell side, get varied opinions, and then try and take a more informed call rather than just reacting to the news based on the limited understanding that news gives you the moment you hear it. So I found that to be actually, while in some cases it may not have worked, but by and large a very good habit to have from a longer term investment perspective. So allows you to kind of weigh the pros and cons of a decision far more objectively. Because when in the heat of the moment you hear a news, you tend to react far more emotionally. It's not that you can never get emotion out of the decisions you're taking, but you can be far more objective if you weigh it out. And we typically tend to weigh it out a day or two. Most of the time, actually, it works. So that is it. And see, there's no point kind of saying I'm right and the market is wrong. Another lesson I guess we all learn, market is always right. So as long as you remember that market is right and market is reflecting a certain truth. Maybe you don't agree with that truth, but that is what the market is reflecting. Now there are two ways to really manage that. One is to say, okay, fine, I'll stick to my guns completely. And if the market makes me feel wrong for 3 years, 5 years time, I am fine. Maybe it works for certain kind of investment. If I were on my personal portfolio, maybe holding a stock and doing an absolute return kind of thing, maybe I'll probably hold on to it if I have the risk appetite for that. But for our kind of portfolios, it doesn't work. So over a period of time, you realize that where you want to kind of draw the line. And even if you believe the market is not really favoring you, if you get your risk management right, in case you get your exposures right at the portfolio level, even in the phase when what your views are not getting played out in the market, you don't suffer too much. So what we try and do is to ensure that we do not suffer too much in terms of the fund performance when the market is going adverse to our thought process. So that will happen from time to time. And not necessarily change our views in a hurry. But if it continues to happen, and it happened, for example, in 2012-13, year and a half, we underperformed, and then we did change our view, and we did make adjustments to the portfolio. Was it right or wrong? I guess in hindsight, answers can be both. But that is the way we would want to operate. But at the same time, if you get your risk management right, you will not necessarily suffer so much that you are forced to make those changes. Idea is to make those changes more voluntarily rather than being forced to make those changes. And that is what we try and do by managing the risk of the portfolio. So when I say that, I may not like a stock, but if it's 6-7% of the benchmark, I may still hold 3% in that. I'll not go zero. I mean, that is something which we'll do. So even if that stock continues to do well and you're underweight, you underperform, but not by the margin you would have done if you had taken a very extreme position. So idea is that we avoid extreme positions. Same on the overweight side. When I could be 200 basis, 300 basis overweight, but will I ever be 600, 700 basis overweight? Maybe not. Because I also believe that, a view may be right, but there will be phases when that will not happen. And there can be instances when risk can come and suddenly that decision goes wrong. And you balance it out. And that works well for an insurance kind of a portfolio as far as I believe. So that is what we try and do to kind of manage so-called drama of the market per se.
There are a lot of books, Prasun, that are written, and this is part of pretty much most conversations that people in the stock market business, and I can sort of widen that definition quite substantially, have is value versus growth. On one hand, you may have a consumer staple company that's not giving you 20% kind of growth, maybe low to mid teens, that's probably trading at 40-50 times, and at the other end of the spectrum, you may have something that's trading at less than 20p or 15p, but nobody still wants to touch it. How do you sort of approach this? At what point do you realize you're sort of paying too much for a company vis-a-vis looking at a company saying that there is genuine value here? Because one thing I've seen over the last at least a decade that I have done the institutional equity business is this one particular stock on the consumer staple side. Whenever people said it can't get more expensive, it just kept getting more and more expensive. And, so I'm sure it's something that you deal with on a daily basis. How do you approach something like that?
So intuitively, when we all started, I think all of us came where the valuation came from a thought process where valuation is the most important piece of an investment. And if something goes beyond a particular valuation, you should sell. And if something falls below a particular valuation, you should buy. I wish it were that simple. Unfortunately, it's not. And that is the lesson you realize as you grow older in the business. So that's a very tough question. So the only way you do it, I guess, is again by balancing out your risks. So I may not like a particular, say, staple sector, for example, given the valuations. But I found it expensive maybe at 35, 40 times. I found it more expensive at 40, 45 times. I found it even more expensive at 50 times. But the fact is it has moved from the 35 times to 50 times. And by being adamant that that can't happen, and being zero and being extremely underweight that sector, it would have been detrimental to my policyholders. So we follow the same rule as I talked about earlier. So if I believe it's a large name, yeah, it is moving contra, and there are reasons to believe these valuations can keep extending, because we have seen a very high concentration of returns in a few stocks, not just in India but pretty much across the world, driven by a lot of different factors, and we can argue on what those factors are in a different forum. But the fact is that is what the market is showing you over the last few years. Now, either you can say that is wrong, and I'm not going to be a part of it. And one part of you tells you that very clearly, because the more fundamental part of you always tells you that, was what the hell is going on? Why would I want to even look at this? But from a process perspective, that is where the process really steps in and says, okay, fine, this is a sector which is expensive. Maybe it is, say, 12, 13% of the benchmark. You want to be underweight? Fair enough. Make it 8, 9% of your portfolio. Choose whatever is you believe is the best bet in the sector or relatively cheaper name in the sector and live with it. So at least then you don't suffer that much. At the same time, if you believe something is undervalued and the valuation is in its favor and eventually it will do well, you don't know when, you allocate to it. But instead of going 300 bases, maybe you start with 100 bases, 50 bases, and then move it up as you see some movement in that stock. So I have found that drawing absolute lines on valuation, that this is valuation is expensive and this valuation is cheap, hasn't really worked out. I also used to think in that way, and part of the mistakes we made in 2012-13 emanated from this, because at that point of time, ITC became the most expensive cigarette company in the world, and I think Sun Pharma became the most expensive pharma company in the world, if I'm not wrong of that phase. And most of the banks, especially the PSU banks, became the cheapest banks in the world by and large. And if you were purely focusing on value, and at that point of time, PSU banks used to be in better health than where they are today. It was not known the kind of risk which they were sitting at that point of time. And if you wanted to pick them up, they look reasonable value, while something like ITC or Sun Pharma or some of the consumer names were not looking great value. And we were making that dichotomy fairly sharp in our portfolios by being extremely underweight on some of these sectors which we called overvalued at that point of time. Just didn't work. So therefore, you start then, that's where the risk management really steps in. Because we don't believe it works for a portfolio like the way we run. It may work for certain other portfolios. Is it the best thing in the world to do? I don't know, but it kind of balances out the risks, allows your portfolios to perform over a medium to longer term period of time. And at the same time, you make less mistakes. This is about making those lesser mistakes. And when you've seen the stocks doing like this, moving from, say, 30p to 50p within a few years time span, where is the logic that this can't happen again? So you have to be careful. But yeah, there are always lines you draw. At some level, maybe you will again say this is now just completely out of whack and we again want to be extremely underweight here. Those calls will also get taken. But those are a little bit more judgmental calls, and as long as the returns remain concentrated in few sectors and stocks, one will have to bide time, but at the same time not really take extreme risk by avoiding that completely. So that is the way we typically manage.
Do you have you spotted any interesting themes coming out of this COVID lockdown period that we've been in, Prasun? I mean, we've had an unlisted what can I say? Maybe a consumer telecom company that's gone on a fundraising spree and landed up raising a lot of money for themselves. But and I asked this from the point of view because you said you're a 3 or 5 year kind of buy and hold strategy that you have. Any interesting themes you think from an economic standpoint that have emerged over the last 3-4 months, or were already in existence but have become more pronounced going forward?
So yeah, what I think is that what will happen is whatever existing themes existed in the world are likely to get accelerated. But at the same time, a word of caution, I think we tend to overestimate the movement or emergence of these themes in the short run. They will all emerge over a longer period of time, but in the short run, say, if we believe education is all going to shift online, or OTT is going to kill the multiplexes, or the way we kind of eat out is completely going to go away, I don't think that is going to be true. Yes, some changes will happen, or people will stop commuting using Ola and Uber and the public transport. See, these are old habits. 3, 4, 5 months of the pandemic are not going to change that in a hurry. let normalcy return, 3 months, 6 months, we'll be back to most of those old habits. But parts of these trends will emerge. I think a couple of things are very clear. I think emergence of digital adoption is accelerated, both by corporates as well as consumers. So if you are a business which is not great at digital adoption, or you're not able to reach your consumer through the digital means, in our view, whatever business it is, you could be selling cars, you could be selling staples, you could be selling pharmaceutical, you could be a hospital, you could be an insurance company, a bank, whichever way. My sense is wherever, if you're reaching the direct customer, your ability to kind of operate on the digital highway, the digital channel, I think is going to get accelerated. So that is another area where one would want to really focus on when one is investing, as to how ready some of these companies are. This consumer is adopting. There are a lot of anecdotal evidence out there. The numbers are there. The adoption of digital payments, the adoption of the way people are consuming some of the products on the financial services side, insurance, banking, mutual funds, is clearly showing that people who were averse to kind of doing it digitally earlier are very open to doing it now. So I think that is something which will probably stay. The rest of the trends will be longer. Yeah, people talk about work from home becoming more pronounced. Maybe it does, but let's face the fact that work from home has been a fairly well-known thing in the US for a while, and then we have famously a lot of companies returning to work from office from work from home. So partly yes, so I will not try and use this to say, okay, the commercial real estate is going to take a big beating. Maybe it does, but I think too early days to really take that call. So some of these trends which look very pronounced, my sense may not really sustain, but yeah, digital adoption by consumers, businesses is something which I'm very, very positive on. And some other things will kind of accelerate, but not to a large extent in my view.
What's Prasun like beyond the workday? How do you de-stress? Are you much into sports, music? Do you play with the girls? Are you a movies buff? What takes you away from work?
Oh, jack of all trades in that, I guess. Yeah. So yeah, I do play. So I'm an avid sports fan. So watch a lot of sports on TV. So vicarious pleasure there. Track most of the sports where India plays, be it hockey, cricket, badminton, football, anywhere globally. Love to follow tennis as well. Play badminton on the weekends. At least used to till the pandemic struck. So that I miss nowadays. So used to be very regular on every weekend. So spend some time playing. Fond of reading. Read pretty eclectic stuff, not necessarily related to markets, but be it fiction, non-fiction, anything which I can lay my hands upon, any varied topic, science, psychology, economics, fiction. So whatever is applicable, yeah, that is there. Music-wise, I'm a bit old-fashioned, so I am more of a Hindi music buff rather than Western music. I listen to Western music, but not much. And they are also pre-1970s, so anything after 1970s looks alien to me. So more like songs which were there prior to my birth, I guess. And a lot of old Hindi film music, qawwalis, ghazals, Sufi, but more the older stuff. So yeah, that is it. So nothing very complicated around that.
Interesting. Playing badminton is not a prerequisite to being a CIO at a fund management house in HDFC, is it? Because even Prashant plays pretty actively, and so that makes two of you who are.
It's just a function of the fact that court is available in the vicinity and taking advantage of that. So that is about it. Yeah, well, you need something to keep you in some shape at when you grow older, I guess. So yeah, so that kind of keeps you. That I enjoy doing it.
Have you managed to catch the onset of cricket over the last couple of days with the?
Oh yes, of course. Yes, and a great spell by Jason Holder there.
Yeah, it was quite
great spell of pace bowling by Holder. Good to see that.
Excellent. It's been excellent chatting with you, Prasun. I know we generally meet as client and broker, but just getting insights into your mind about how you've gone about things, your career, what you look forward to, your processes and systems. I think I personally have learned a lot about you. I'm sure our viewers have as well. So I really want to thank you for giving your time. I know it's been an extended conversation, probably more than what you were used to doing when you were business media, but I hope you had fun being on. I hope it was something different for you. And
absolutely. Thanks a lot, Rahul. Thanks a lot for having me. Yeah, it was fun, and Yeah, probably wasn't prepared for these kind of questions, to be honest. So what I spoke was what came directly to my head in terms of what we do. So yeah, that's exactly what we do at HDFC Life, and that's the way we manage the funds, be it equity, fixed income, whatever it is.
That was exactly the plan, to not have it a conventional interview. And since you said it was all unplanned, I'm just going to sign off by giving you examples of two cricket captains, Imran Khan and Saurav Ganguly. Imran Khan actually famously picked out Wasim Akram and Inzamamul Haq literally from the streets, and so did Saurav Ganguly when it came to people like Virender Sehwag, Harbhajan Singh, and Zaheer Khan. So
And
sometimes,
Yuvraj Singh, in a way.
and two of the
Yeah,
greatest captains in the history of the sport, you can argue.
absolutely.
So sometimes unplanned things are good in life. You never know where they take you, and it probably
Absolutely.
eventually works out for the best. It's been a pleasure, Prasun. Thank you so much for taking time out. Hopefully, I'll see you in person soon enough once this is all behind us. Stay safe, and it was fun. Thank you so much, and I'd like to thank all the people who joined into this broadcast as well for your participation. Thank you so much.
Yeah. Thanks, Rahul. Thanks. Pleasure has been.
Yes,
Thank you so
stay
much.
safe. Thank you.